This program is paid for by EG Tax.
The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our time to talk taxes. We want to save you the most amount of money possible. And if you listen to some of our tips, you could cut your tax bill by thousands of dollars if you do something with what we say. And of course, I'm joined in studio with my buddies, Tiffany Fabian. Hey, Tiff.
Hey, happy Saturday.
Happy Saturday to you. And Christopher Fabian.
Hello, Esther.
Hello, Christopher. So it was a terrible couple of days, you know, with the death of Charlie Kirk and with 9/11, and we want to just express our condolences to the Kirk family, and you know, no matter what side of the aisle you're on, you know, shooting somebody's not a good thing.
No,
right?
death is never a good thing.
Nobody should be assassinated.
Right. Anyway, so we just wanted to start off with that. I'm going to go see Downton Abbey tomorrow. I can't wait.
Oh, that's a joy.
I mean, I used to look forward to that on Sunday night.
Yeah.
And so when I was thinking if it was only during church, I was gonna go. I want to go see Downton Abbey. So that's tomorrow. And then of course this week we have our seminar. We only have 8 openings left on our Thursday seminar, right?
Correct.
Yep, so
if
call
you
or go
are
online.
interested in learning about the one big beautiful bill and how it affects you and kind of a little hands-on workshop, you can go to our website at egtax.com and register. And the only opening we have now is on Thursday, and that's from 1 to 3, right?
Yeah.
Yep, and so it's a 3-day seminar. It's a same stamp. One day is the same as the next. So if you come on Thursday, you're getting the same information as the other 2 days.
Right. But our room could only hold so many people, right?
Correct.
So, and then the other thing is, we have our tax school that's starting in October, and if you are interested in what we talk about, we go in depth with our tuition-free tax school, and it's absolutely great. And again, you can go to our website at egtax.com. And those people that have that love people and really want to help people, that would be, you don't have to have this great math skills and you don't have to be good with computers, because we kind of spoon feed you all of that, and everything is done on computer anyway.
I just want to give a little testimony. I was at the Elmwood VA about a month and a half ago, 2 months ago, and there was a registered nurse I was talking to, and then we got to talking, and I said I work at EG Tax too. She goes, oh, my husband is a retired sheriff and he works there too. He just started a few years ago. It's his retirement job. And she goes, he absolutely loves it. So it's just sort of a testimony of a good example of somebody who does, who works for us after his job, his difficult, stressful job. And it's just a job where you're just blessing
another
people.
difficult, stressful job.
Yeah, in
right?
just a different way.
I mean, but it's so lovely. I mean, I love helping people. And when I save people money, I get more excited than they do. Maybe because they don't realize how much we really saved them, right? Sometimes that's the case.
Yeah.
We do this stuff and it's so automatic, and you just got somebody an extra $2,000 or $3,000 they don't know, right?
That's right.
Yep.
That's right.
So anyway, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. Love to hear what you have to say, but basically what we're going to talk about is some loopholes that you can do if you really listen to what we're saying, and you can modify, because here it is, mid-September. You got the rest of September, October, November, December, and some of these things can really save you money. And so I thought, let's talk about them. So the first thing I want to talk about is if you're somebody with wages, okay? So if you have income from wages and you had overtime, one of the big changes with the big beautiful bill is that your overtime wages are tax-free up to $25,000, correct?
Yep.
Provided you come under that income
Yep.
limitation.
And I know you're about to get to tips. We were out eating dinner last night, and Chris is just like, it's so wonderful that this waitress won't have to pay tax on some of her tips. And
They don't even know it, because
I know.
sometimes I'll see that 20% that I'm supposed to tip them, and I'm thinking, gee, their first
Tax-free.
$25,000 in tips is tax-free. They're going to save $5,000 in
Yeah,
taxes,
and not
but
to-
I'm still giving them 20%.
I mean, I'm starting to sound like you in the long ago ages. I was a waitress at a restaurant, and I didn't get minimum wage. I got hardly anything. Now they get minimum wage too. So, wow, it's great.
But so anyway, tips and overtime. So if you got wages and you've worked overtime. Now, Chris, explain that the overtime isn't as clear cut as people might
Right.
think.
There's
right?
no black and white ruling on it yet. They don't know. Say you get $20 an hour, your regular hourly wage. So when you go to collect overtime, you're up to 30 hours. There's no ruling on whether it's
Yeah,
the
there is.
full
They came up with it.
whether
Yeah,
it's
last week.
the full $30 an hour, or is it do you only get to the $10 an hour that is
You
tax-free?
only get the $10 an hour. In other words, your regular wages, you're not going to be able to deduct. But the overtime portion is what's going to be the deduction, limited to the $25,000, right?
Right.
So, but the bottom line is, let's say you have overtime of $10,000 and you're in the 20% bracket federal, you'll save $2,000 in taxes. But you have to make that adjustment on your tax return to do it, and this is over and above itemized deductions. So that's one thing, and the same thing with tips. Now, tips, it's the whole tip. That's going to be deductible as if you have wages. The other thing, if you have wages, you can then contribute to a pension plan at work. And if you are at a company where there's an employer match, you are literally throwing money away by not being in the pension plan.
Oh my word, yes, because of the match. And so, my goodness, at least do up to what the match is, because a long time ago, my mom told me,
Why
don't
don't you explain that? Because that maybe people don't understand what we're saying. What is a match? Not the kind of thing that would light a fire, right?
Well, maybe some people need that under their butts.
Yeah, that's true.
Well, what it is they put in 3% of your wages if you contribute to the plan. So if you make $20,000, 3% of that is $600. If you make $40,000, that's $1,200. So if you but you have to put in that much money. So if you put in $1,200 at $40,000, they're giving you another $1,200.
Right.
So that's
and it's tax deferred. It's not taxable until you take it out.
right.
defer.
Right. So the money that you put in plus your employer match, that's like free money. You didn't have to work extra for it. You didn't have to come scrub floors. It's just because, the guy that owns the company, he can't contribute to his own pension plan unless he does the match on yours. That's how the law works. So you still have time to do that so that you can make your match, right?
That's right.
And if you have children and you have wages, that opens up a whole other bunch of credits, right? And a credit is better than a deduction.
Oh, yeah, definitely.
So
definitely.
if you have children that are dependent upon you and you have earned income, you might qualify for the earned income credit. Now, what does that mean?
Go ahead, Tiff.
Earned income credit is up to 3 kids. So if your income is not that high, you will get a credit for your children.
Well, actually,
And up
it's
to
quite
the-
a bit of money, though, isn't it, Chris?
Yeah, now
oh my
it's
God.
like $55,000.
The
Right.
limit.
Your wages, right?
Yep. And
And that-
also
and-
New York State gives you one. Go on, Chris.
And that could give you, I mean, depending where you fall from 0 to 55,000 and how many kids you have, you could get a refundable credit of up to like $6,500 from the federal. And not to mention, like Tiff said, New York State has it too. So you could be getting about $10,000 extra.
Because you've qualified for the earned income credit and you had a job. So for those of you with children that are dependent upon you, regardless of their age, if it's like for instance, if it's a handicapped child, and you have wages, you would, and your income is lower, you would qualify for the earned income credit with a handicapped child. But pretty much once the kid reaches 19 or is not a full-time student, if they become a full-time student up to 24 and they're still your dependent, as long as you have wages, you could get these credits. But if you don't have a job, or you're not self-employed, or you think you're working under the table, you won't get those credits, right?
No, you have to have wages, and so you have to have earned income, and it has to be reportable earned income, because you should report all your income.
Well, let's say that you're a housekeeper and you make $30,000 and you think it's under the table and you got 2 kids at home. What would you suggest that person do?
Get a job, and I got a story for that after the break.
I know we got to take a break, but the thing is, they got a job if they're a housekeeper, right? They're self-employed.
Yeah, right.
All right, we're going to take a short break. I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We'll see you on the other side. All right, excuse me, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. We'd love to hear what you have to say. I will tell you what we're talking about are things that you can do to make yourself some money. There are people that think they're really doing something by working under the table, and they got kids at home, and if they just claim the income, I don't care if it's cash or not, they claim the income, they could qualify for all these credits.
Yeah,
right?
not to mention someday, I think Chris talked, who were you the other day talking to this about, when you go to collect on your Social Security, you're not paying in, but you had a story to tell, Chris.
Yeah, so well, like you, if it was a housekeeper who didn't claim her income, she loses the money. But I know this one lady who has 2 kids and she doesn't work, and I've been telling her for 15 years, go get a job, just a part-time job while your kids are in school.
Right. Any money makes it you qualify, right?
Right.
Not
right.
for the whole thing. It gets bigger as your income gets higher, and then it caps at around 15,000, and then it gets a little bit lower. But the thing is, any income would qualify for in wages if you have children and you have low income for the earned income credit.
Right,
Go on,
yeah.
I'm sorry.
Yeah. So she came in this year, a week ago, and she goes, "Oh, I'm going to owe so much money this year. I'm going to owe so much money." And I look at her W-2 and I see she only had $100 of withholding and with $29,000 in wages. And I'm like, I don't think so. And she goes, "Yeah, I know, I'm going to." So I did the return, and she gives the exemptions to the father of the children, but she still had a $4,500 refund on the federal.
Yeah.
And on New York State?
And New York State, she had $1,500. So she got back $6,000
That she didn't know she had.
that she didn't know she had coming.
And that's a really good point. Let's talk about that. If you have a divorce situation where the non-custodial parent, who's usually the father, has the right to claim the personal exemptions for the kids and the child, there is no personal exemption anymore, the child tax credit for the kids, does that preclude the mother then from not getting the earned income credit?
Oh, no, they still get it.
And they get the wonderful filing status of head of household. And so they don't get the child tax credit, but they get the earned income credit. So they're just going to indicate on their return that they're the custodial parent, and then they get head of household, and they'll get the earned income credit, which is just a wonderful thing.
And let's say somebody's listening, and for the last 3 years, they haven't filed. They gave the kids up to the dad, and they've been working, and they didn't have that much money. They were under minimum filing requirements. All right, so they didn't file. So what should they do?
they should come and file.
And get their money.
Yes, they should come and file. The statute of limitations is 3 years, so you have 3 years to file those returns, and they'll pay you interest. And please come and do it. The New York State,
telling-
3 years too.
It's so sad because, your friends over you call and you say, do I have to file my return? I only made $14,000. And so you say, well, no, actually, that's under the standard deduction. You don't have to. However, if you have children, they're going to give you money back, even if dad is claiming the children.
Oh, yes. Oh, yes.
And, so
mean-
that's another thing. If you got wages and if you're self-employed, after you take off your expenses for making the income, you're going to end up starting to pay into FICA. But the credits for the kids, oftentimes, if not all the time, covers that Social Security. So then you're paying into the system, and so you'd have money upon your retiring and get the other credits, what's ever left after you pay the FICA.
Right. Right.
Yeah,
Yep.
yeah. And so, anyways, go on. I'm
All right,
busy doing three things at once.
That's what wages will do. And if you have a corporation, let's say you're the principal of a
But-
corporation, and you say, well, I don't want to pay myself because I'm the CEO. You have to pay yourself a reasonable wage, right?
Right.
You do. Yep, you really
And-
do. And I got to say, while you're on that train, Chris is
Not on the train.
Choo-choo.
Chris is a really good teacher. If you're an S corp and you have loss after loss after loss, and you're paying yourself a salary, after a while you have to scratch your head and saying, "Are you putting your salary back into the company? Are you getting a loan? How is this company staying afloat?" And I just want to say that there's more to what's in the stew than what you can just originally see. You know what I mean? It's a very complex
and that's
situation.
really a good point because I was going to bring that in a little later. But the thing is, if you have a corporation and it's a C corporation, first of all, it pays taxes twice, right? And the flat rate is 21%.
Right.
And if you have a loss from your corporation, you can't take that loss. Those losses on a C corp just move forward. So you are shooting yourself in the foot because you can't take the loss. If you have a gain, you're paying taxes on it twice, and you're paying at 21% flat rate. So what can you do? What should you do?
Well, I mean, you should pay yourself everything, and this way the company doesn't pay the money. You figure out your net profit before you take a bonus at the end of the year, and you zero out, or you zero out the income on the corporation, so you get the wages, which help increase your Social Security.
But I guess I was fishing for you to say you make the election to become an S corp.
Yeah, that too.
Oh, yeah, if you're a C corp.
Right? So just very simply, you just make an election, and you can become a subchapter S corporation, which means the net profit's only taxed once.
Yeah,
And if
because-
you're in the 12% bracket, you pay 12% rather than 21%, and you don't pay it twice.
Yep, I do several handful of C corps, and the thing is that, like you said, they pay taxes twice. They pay it on their earnings, and then they get a dividend that they have to pay taxes on. Ugh, it's so taxing.
Bum, bum.
Yeah, right. Okay, we got a text.
We do. It says, Esther, will there be a code on your W-2 form saying how much of your wages are tips and exempt overtime, or you have to figure this out yourself?
I think that they're not going to trust you to figure it out yourself.
Well, the tips is
and
easy.
right now, we were talking to our software provider the other day, and they said they keep having meetings and they're trying to figure out what you're supposed to do, right?
Yeah.
Right. The tips are easy because there's already a box for
Yes,
tip.
you're right.
For tips. So maybe this is a way for get them to claim all their tips so they're paying more into Social Security and they won't pay tax on, income tax on it. So that's an easy one. The W-2s for overtime, I believe there is going to be a code in box 12 or box 14. So because like you said, they're not going to trust the people to just say it.
Right.
Yeah.
And for, but the payroll department would know how much overtime their overtime is. The thing is, you'd have to back off the regular wages off of there.
And then don't
Right.
forget, it's the tax-free portion is not your, like you just said, the regular wages. It's only the amount of overtime or the tip. It's not your regular
Right,
wages.
but you have to pay FICA on the whole thing.
Yep.
So,
And this is only the federal.
oh, I know. On New York State, they're going to say, no, add it back.
Yeah.
Boy, that's going to be a lot of letters.
Yeah.
Oh, well,
Right. Not from us, but for people that did it themselves.
So
right?
to reiterate for our texter, it's easy. There's already a box for your tips, so that's already on your W-2, and the overtime we're just, it's sort of a stay tuned and we'll find out. But the tips is easy. They've already denoted and set that apart. You know.
Okay, so talking
And-
about wages.
wait,
what's good about,
Sorry.
Yes, sorry.
Just was Googling. It looks like
you weren't
there's
doing
going to be
AI.
a code, either TP as in toilet paper or TT as in Thomas on the W-2 in box 14 for the overtime.
Okay, that's great.
So
Okay, the other thing about if you have wages, and this is all talking about wages here. If you get laid off from work, you can collect unemployment. If you are somebody that says ABC Corporation's paying me cash and I'm not claiming it, number one, that's illegal. Number two, if you get hurt on the job, if you are laid off, you can't collect you can't collect your unemployment. And how much is unemployment maximum now?
Up,
They just
up to
changed it.
$850 a week
869.
if you qualify. I mean,
$869 if you
week.
qualify. So you think about that. That's over $40,000 that you could get in. Actually, it's not that much because of the 26-week thing, but a lot of money. And again, these are just things that you can change the way you're doing it, and it'll work for you. And I got a break for the news. We'll be back on the other side. Hey, to us, you are family, and I'm going to tell you, you don't have to ever think, oh, I didn't use them. I can't call and ask a question. Are we really like that?
No, not at all.
We don't say, did we prepare your return? We don't care. We just want to help.
yeah, taxes. It's very, very confusing, and
Our tax is taxing, Tiff.
yeah, I know. I just used that. It's fun, but I don't. It just rolled off my tongue.
But it's so wonderful. As a matter of fact, taxes are so hard. Yesterday I was playing around with AI, doing some.
Oh, yeah.
To see how good their computations were. So I did it with a Social Security taxability, and I asked it a question, and it gave me the answer.
For her.
And I wrote back and I said, "You made a big mistake. You forgot to take off the $32,000 floor." And it goes, "Good catch." So anyway,
So
they
you're
made,
smarter than AI.
well, they made
You are.
they made several mistakes, but it was fast.
right.
But there are mistakes.
But it gave three
And it
wrong
made
answers.
the same mistake a few times. I mean,
Well, they did three wrong answers.
so it didn't
yeah.
even correct
But
itself.
but once I told them, I said to them, you got to take this, and then you're right. But the new AI, it's very conversive. So
Yeah.
you can converse with it.
Oh, I'm
okay. The
sorry
other
you
thing
did
is
that.
because we're really trying to get you to understand, if you do stuff, you save money. Now, interest income is fully taxable at your tax rate. Okay, unless it's a municipal bond. And so municipal bonds pay a lower interest rate, but they're fully tax-free on the federal and maybe on New York State. How does it get to be tax-free on New York State?
They have to be issued from within New York State. So New York State itself, Erie County, Niagara County, Chautauqua County, Manhattan County, the cities, Clarence, Williamsville, West Seneca, Orchard Park, anything like that, the Erie County Water Authority, anything like that issues bonds, those are considered muni bonds, so it's tax.
A public right?
Yeah.
The general
So
government
right,
entity.
where you might only get 2% instead of 4%. But if you get $5,000 of interest that you're not paying taxes on, both on the federal and the state, I mean, that could say you could save maybe $700 to $1,000 in taxes, depending what bracket you're in. So
Which is true, but here's another thing. If we move down to dividend and investment income, if you have qualified dividends and you're in the below 15% bracket, what would you pay on those dividends?
zero.
So let's say that you have $40,000 in a bank account that would have made you $1,600, but you go to a blue chip stock that pays $1,600 in not interest, rather, they pay $1,600 in dividends. Those dividends, if you're in the under 15% bracket, you'd pay zero on. Whereas if you kept it in the interest income, you would pay, if you're in the 20% bracket, over $300 in taxes. So moving it from interest into dividends and capital gains get special tax treatment. A lot of people, when they call, they'll say, oh, I gotta pay capital gains. Much better that you'd pay capital gains than have it be ordinary income, right?
Yeah, I had somebody call me the other day, and she has a life insurance package, and so almost like an annuity, and so there's a gain of like $60,000, and of course this is not stock, but she was wondering, I was telling, this again is not stock, so it doesn't qualify for the 0%, but I was telling her, paying the $60,000 gain on the growth is something you have to take into consideration, and so she also thought she had Medicaid, and so it would preclude her from getting Medicaid. There's all these pieces and parts that you have to talk about and think about when you're selling stock, like you said, or selling life insurance. You just got to think about the whole picture.
Because
and,
one part of the puzzle affects the other part of the puzzle.
That's right.
Right?
That's right.
And so you can be doing something here, and then you find out that it's going to negatively affect maybe your STAR program, maybe it's going to negatively affect your Medicare because it becomes a IRMA kind of thing. So there's all these things you have to take a look at. But here's the thing: if you have qualified dividends and capital gains, and you're in the 15% bracket or lower, you pay 0% on those gains.
Yep.
And so if you have money in the bank, something to think about is to put it into a blue chip kind of stock that has really good dividends, because you'll make the same, if not more, and it won't cost you anything. Right? I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And here's the other thing is, at the end, this time of year, let's say, the stock market's gone bananas. Look at it the other day on Friday. It went crazy. So let's say you have done really well this year, and you call your broker on Monday and you say, gee, how much do I have in accumulated dividends and capital gains from stock that you've been trading all year? And by the way, if your broker moves the money from stock A to stock B, that's a sale. It's not
right.
Oh, he just moved the money around. Yeah, he moved the money around and it's taxable. So now you want to take a look and see, do you have any losers? Because if you take and sell your losers against your capital gains and your qualified dividends, what'll happen is you can dollar for dollar take that deduction plus $3,000. So I'll give you an example. So if you had $10,000 in qualified dividends and capital gains, long-term capital gains of 40, now you got 50,000 in capital income. But let's say you had 30,000 in losers. If you sell the loser, you can use that whole 30,000 against the 50,000, and you'd only pay taxes on 20, and the maximum you could pay is 20%. So you'd pay 4,000 in taxes. If you didn't sell your losers, though, so that the whole 50,000 was taxable at a maximum rate of 20%, you would pay 10,000. So see, you save $6,000 by harvesting your losers. Then you say, oh, but I really think it's going to do good. And so you can buy it back in 31 days, right?
Yeah, it's so funny that sometimes, to interject little personal ad libs, Chris and I I'm very conservative, and so everything is in my 401ks and safe. Doesn't gain a lot, but it's like in U.S. savings bonds, et cetera, et cetera. Well, there was a company having an IPO, and Chris went and invested $2,500 in stocks in this thing he's never done before. But it was
Chris is losing his mind.
his wife is losing her mind. But sometimes it's good to. A client told me one time, I love my clients. She goes, Tiffany, she goes, invest in stocks and things that she's doing really good in the market, and things that you like and companies that you like and things you believe in. She goes, I tell my family and friends this all the time. So I think that's sort of what you did, right, Chris?
Right. But also, though, not just to end that story, but to end that story, if you're a do-it-yourselfer and you're harvesting your losses, you're only allowed a $3,000 overall, a $3,000 loss on your tax return, and then the rest is carried forward for the next year. But if you don't put it on the next year's return, even though you don't have a Schedule D, the IRS isn't going to remind you.
Nope.
You'll lose it. I had somebody the other day come in. I was doing. They sold a property, and they're like, "Oh, how much money am I gonna owe?" And da da da. So I worked it all up, and they were gonna owe $30,000 between the federal and the state. And we got to talking, and he goes, "Oh, you did our return back 3 years ago." I looked at it, and he had a $90,000 loss carry forward. But guess what? On his 23 and 24 return,
He didn't take it?
he didn't take it. So
my
I amended it to put it on there. And by doing that,
Saved him all this money this
for
year.
2025, when we do that return, his tax burden is only going to be $5,000
And
instead of 30.
TurboTax or AI didn't let him know about the.
Right.
Yeah.
Well, I mean, I just wish I could have time to look at everybody's tax return. You know, so you can, if you're selling against, if you have losses against capital gains, you can do that dollar for dollar plus $3,000, and like Chris says, the rest of it you can carry forward. One other thing before we get the phones, 8030930, 8030930, star 930 on a cell phone. Text us at 716-8030930. Here's another thing: if you're somebody that gives money to charity, all right, one of the best things you can do is give an appreciated asset to that charity. Because if let's say that you give $10,000 to charity every year, and you have stock that's worth $10,000 that you purchase for $2,000, so you have an $8,000 gain. Okay, if you sell that in order to give the money to your charity, you're going to have to pay taxes, maximum 20% or $1,600 in taxes. But if you give the charity the stock, the appreciated stock worth $10,000, you pay nothing, and you get the $10,000 deduction. I mean, it's a win-win.
Yep.
So this is what when I was getting ready for the show this week, I just thought, I'm going to look at all of these weird things in the law, and if people did the weird things I tell them to do, they would be happy at tax time, or happier, right? Mm-hmm. Well, hopefully. Anyway, and we got our man from the islands waiting. Hey, Kev.
Hey, morning. Hello, folks. How you doing?
Good. How are you doing, Kev?
Yeah, you know.
I know. It's been a tough week.
Yeah, it's been.
Yeah, it was a tough week.
Really, really tough week. Yeah.
I personally shed lots of tears. Okay, go on.
Yep. Yeah. Hey, I wanted to ask. I know. I think it's 20,000. Once you start taking Social Security, is only you can only work for like 20,000 a year or something like that.
Well, it all depends on your age. How old are you?
Oh, yeah, right. Yeah. Well, I'm way from.
You're 41.
Retirement age.
Way from retirement age.
If you are in full retirement age, then the amount of wages that you make are limited, and you'd have to pay back any. I think it's $1 for every $2 you make over that wage threshold. But once you're at full retirement age, you can make whatever you want in wages.
Oh, right. That's what I wanted to find out.
Yep,
Because,
so-
just saying that you can only work for 20, what is it, 20 grand a year or something?
Yeah, like
You know,
around
if you're not at full
22.
retirement age.
22.
I said, hey, I'll be working beyond my retirement age. What the heck?
Yeah,
but
but you know the correct
do.
figure, Chris?
22.
It's right around 22,000 for now. It
So-
goes up every
So
year.
let's say you start collecting Social Security at 63, and you want to keep working, and you say to your employer, I think I'll work part-time, you make 20,000, and you have your full Social Security, that's cool. But let's say that your employer says, we want you to be the vice president of the company, we're going to give you a $100,000 salary. You would not start collecting your Social Security then early, because you'd end up having to pay it all back. Actually, it gets added on back to your own account, but you basically lose that benefit. But once it's full retirement age, and you're like 66 and whatever months old you are, you can make as much as you want. 3 million, 12 million. You can become a Buffalo Bill, make 45 million. Kevin.
Once you're at full retirement age, the sky's the limit.
Hey, you can be the field goal kicker. Look at we got a
Oh my God, I
40-year-old.
love that man.
There you go. All right.
love
Hey,
that,
thanks
man.
again.
Hey, Kevin.
So you take
Are we
care,
going to
all right?
win tomorrow?
Yeah, man. What do you mean? Yeah.
Yeah,
we
man.
will.
I like that. Hey, thanks for calling,
right,
Kevin.
see you then.
All right, I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 into cell phone. Text us at 716-8030930. We're going to take a short break. We'll be back with your calls on the other side.
The bills make me wanna shout. Kick your heels up and shout. Throw your hands up and shout. Throw your head back.
I love the Bills. I hate watching them, but I love them.
Yes, you'll be in the closet tomorrow.
I'm
we know.
telling you, no, actually,
You'll
what
be
I
on
do,
the boat.
I wake up at like 1 o'clock in the morning because I know it's over, and I know Tiffy's gonna text me an L or a W. And so the other day,
W.
I got up at 1 o'clock in the morning. It said W. So then I went to the TV because then I want to
Impossible.
I want to watch it then because
Highlights.
because I know they already won, and so I don't have as much agita. So I turn it on, and then I fast forwarded it to the third quarter because I didn't like the scores, and I'm thinking Tiffy must have lied to me. So then I
was
get to the
joking
fourth
you.
quarter, and we're really, really behind, and I'm thinking this was a terrible joke she played on me.
Sounds
Then
like a
all
Becca
of a
joke.
sudden, we won. So and I'm at 1 o'clock in the morning or 2 o'clock in the morning. There's not too many people you can call. Nobody will talk to me. So anyway,
It was unbelievable.
It was unbelievable.
Those are the reasons you can't watch.
I can't because because I'm too invested in it.
Yeah.
Okay, we got somebody calling from Clarence. How are you?
Good. How are we doing?
This is Al, right?
This is Al. How
Hey
you doing?
Al, what can we help you with?
So regarding the charitable contributions, and you said if there's a stock that appreciates over the course of the year,
Over
You
the
can
course
get-
of the ownership,
over the course of the ownership,
right?
does that also apply to C corps if they own the stock and it appreciates? Can a C corp take the same advantage if there's charitable donations?
Yeah.
They can.
Yeah,
So
I
does
mean,
that have to be done at a personal level?
if it's given to if the corporation has made a gift, a gift to it, a qualified not-for-profit, then that the appreciated value is going to be the deduction.
Beautiful. So if a business owner had in fact a C corp, they would be better off if they were to typically give personally at the personal level to charities. If they had a stock that the C corp owns that had appreciation over the course of the year, they'd be better off giving through the C corp instead of taking the profits and then giving to charity at a personal
That's
level,
right.
so they're not double
If
taxed.
you can give that appreciated stock to the charity through your business or through your personal, it's much better because then you don't have to pay the taxes on it, especially
Beautiful.
double taxation on a C Corp.
Yeah, exactly. Beautiful. All right. Well, I
Okay.
appreciate the help. Thank
All
you
right,
for the
thank you.
clarification.
And the other
Good
thing is,
question.
before we run out of time here, I wanted to talk about seniors who now have a standard deduction with the 12,000 of almost $50,000, and so they say, well, I don't have to file, and that may be true, but should they take a look at their 401ks and their IRAs and take money out even though they don't have to?
Well, depending on their income and what, if they're under, if they
Let's
don't
say
have
they're
to.
on Social Security, full Social Security, and they aren't taking any money out of the 401k or their IRAs.
Yeah, then they should, because depending on their filing status, they could take anywhere 10 to 15 to 20,000 out and pay no taxes
Now, why would you want to do that?
because you're paying no taxes.
That's exactly right. And so many people say, I'm going to put it in a Roth so I don't have to pay taxes. Put it in a, and all this time they could have taken it out and set it aside in other investments or moved it into a Roth. They could have done a Roth conversion. But they just say, well, I don't have to take it, so I'm not going to take it. But just because you don't have to take it doesn't mean that you shouldn't take it. The
Right.
income, right?
Right.
Because that's good tax planning.
Right, because how many people go, oh, I want to convert 50,000 to a Roth so I don't have to pay taxes.
Right. But all this time, you weren't going to pay taxes anyway,
Yep.
right?
Right.
And so that's part of what we're going to talk about at our seminar that we do Tuesday, Wednesday, and Thursday, right?
Yes.
That's right. Planning on the big,
other
beautiful
thing,
bill.
the other thing is on a QCD. Well, since we're still talking about how to take advantage of the deductions for charity, explain a QCD and who should do it and how it works.
Sure. So if you are of age where you have to take your required minimum distributions, you could take your required minimum distribution and roll it over to a qualified charity. And Chris, I was asking you the maximum per year, but go ahead. What's the maximum? 60?
105,000.
$105,000 per year. You could and you don't have, doesn't have to be 105,000. You could do as much as you want, and you could roll it over to your charity of choice. It has to be a 501c3, and that way it saves you taxable income. Less of your Social Security is taxable, especially because you get the extra $6,500 this year, possibly if your income's not too high, if you're over the age of 65. And then you're a philanthropic type of person, and you're giving to your charity of choice. And so if you're of the age where you're going to do your RMDs, that's a really good option.
Right. So let's just give you an example. Let's say that you're somebody that has to take $20,000 out of your IRA and pension because you've reached 73. But every year you give $10,000 to your favorite charity. If you did a qualified charitable deduction and took the $10,000 that you were going to give to charity anyway and did it through your broker, who's ever handling your money, so they do a direct transfer from your 401k or IRA to the charity, then only the portion that wasn't given to charity becomes taxable. The portion that goes to charity is tax-free. So if you're in the 20% bracket, you would save $2,000 in taxes doing it that way. That's a good deal.
Yeah, it is.
That's a good deal. And we got a text here.
We do. It says, gang, I am recently divorced with 2 children. I receive Social Security income, and I have no does that say earned income?
Yep.
And medical income. Can I file?
I have no earned income.
Okay, it just,
Well,
I
so
can't see.
it must be on Social Security disability, right?
Social Security income.
Yeah,
Yep, it says
probably.
SSI.
Because it seems that somebody that has regular Social Security means that they're over the age of 60 something, right?
Yep.
So then how do they have young children? However, if it's a gentleman, they always look for the younger woman. That's possible too. I would suggest that they get some wages Because then they'd get an earned income credit.
Right, because even if if it is just regular SSI, you can make up to 22,000. If it's SSD, it's a little bit lower, but you still can have a little job, because even if you make $6,000, you'll still walk away with probably about, depending how many children you have, 2 children, probably about $3,000.
And on the state, so like $4,000. So,
Yeah.
In essence, if you get a little part-time job making $5, you'll end up with like $4 in refunds. That's $9.
Yeah, so like you said, if you get a job like cleaning houses or watching other kids, just a small job would help you to get an earned income
And
credit.
this time of year, it's fall. We're getting into the Christmas season. A Christmas job,
Yeah.
And a lot of times you can work from home if you can get a remote job, so you can be with the kids.
Yep, most definitely. All good, really good options.
Right. So, and the thing is, you don't have to worry about your Social Security being taxable because you're the head of the household, right?
That's right.
And so when you take half your Social Security added to your other forms of income, you subtract it from your standard deduction being head of the household, you're going to find out that your Social Security is not taxable, but you're going to get all this money back on these credits. As a matter of fact, you get the refundable child tax credit too if the kids are under the age of 17.
Right.
Right? If
Yep.
you make, how much is it? Like 1,700?
Yeah, they reduced it. So yeah, they're doing that.
So I mean, really and truly, we were talking a lot about wages today, but if you're somebody that's not working, or if you're somebody that thinks you're so smart because you're working under the table, the truth is, it's illegal. You're not paying into Social Security. You can't believe the benefits there are by claiming all of your income, especially if you have children, because it's a win-win situation. What people think is, I'm not reporting it, so I'm really pulling a fast one over the IRS. The truth is, the way our tax code is written, and that's why our tax school is so great, you find out that it's like a welfare system. Our tax code pays people that are lower income so that they can make ends meet, and none of that is taxable, right? Anyway, I'm Esther Golias, the tax lady, with Tiffany Fabian, Christopher Fabian, and during the week you want to give us a call, just call us at our corporate headquarters. You can go to our website at egtax.com. If you haven't registered for tax school, do it as soon as you can, because we're getting close to the opening day, and you can do that through our website as well. And if you're coming to our seminar, we look forward to meeting you. I can't wait to meet everybody, because there's so many things that are so good in the recently passed One Big Beautiful Bill, and we're going to straighten all that out too. So until next week, I'm Esther Golias, the tax lady, with my buddies, and go Bills. Talk to you next week.